Hey Empower Visionaries, welcome back to my channel. My name is Shamvira K. Shepherd. I am a purpose coach, speaker, and entrepreneur. I empower professional women to tap into their true selves and uniqueness to pursue careers aligned with their purpose. Now, on this channel, I also provide information on the process of homeownership to help build stability, legacy, longevity, and possibly financial freedom. Now, in this video, I will be talking about the indicators of unacceptable credit through USDA's single family housing 502 direct loan program. Now, if you haven't watched my previous video on how to prepare yourself to purchase your first home in 2024 with no money down, I would highly recommend that you do watch that video, as this video here stems from that video. So I'll make sure I either put it in the description or it'll be somewhere here on the video. So let's get into it. Now, at the very top of this page here, there is a note, and it's really important that I go over this because I really want you to understand exactly what USDA means by this. But it reads, to be eligible for a Section 502 direct loan, applicants must demonstrate that they are reasonably able and willing to repay an agency loan. An applicant's credit record does not have to be perfect. A few instances of credit problems can be acceptable if an applicant's overall credit record demonstrates an ability and willingness to repay obligations. Now, next part is very important. So it says an applicant with an outstanding judgment obtained by the United States in a federal court other than the United States tax court is not eligible for a Section 502 loan. This requirement is statutory and cannot be waived. So if this applies to you, then I would advise that you get off right now and not move forward in the process, as you would not be eligible for a Section 502 loan. So just wanted to go over that. And I just really want to touch on these two parts here, your ability and your willingness, okay? And go over what USDA means by that. So we talk about the ability. It has to do with the applicant's available, reliable income. It considers whether the applicant has adequate income to repay their debt obligations from stable income sources. So obviously, if you have a job, they're definitely going to check that to see, whether you are self-employed or if you are working, or if you, get, some type of check or something. You could be in retirement, have retirement funds, or, get some type of retirement income, or SFH checks, or something in that nature. But obviously in most cases it's going to be from some type of reliable source. Now, when we talk about willingness, on the other hand, it means that the applicant not only has funds available, but is willing to use those funds to pay their creditors. In other words, you could be a millionaire with more than enough ability to pay your bills, but if you choose not to pay those to whom you owe debts, then you don't show a willingness to do so. So both components, ability and willingness to pay, are critical to the credit analysis. Now, I can also go over some examples of what that looks like in regards to someone having the ability or willingness to be able to pay. So there's two examples, example A and example B, and we'll go over. So I'll probably go over in some other videos in regards to like some of the specific requirements that USDA requires as well. But one of them is in regards to the credit score. And I think I touched on this in that previous video on how to prepare yourself to purchase your home. But if your credit score is 640 or better, then you go through a streamlined process. So basically it doesn't have to go through like the extensive underwriting process. So it's always good if you have a 640 credit score or better, you'll put yourself in a good position. So they look for 3 credit scores, and that's Experian, Equifax, TransUnion. Now, if you have 3, they're going to take the credit score that's in the middle. If you only have 2, they're going to take the lowest score. If you only have 1, then that's the only one that they can use. But obviously, if it is lower than a 640, then they're going to require some additional information. So let's just look at this example with John and Mary. So, of course, in this example, John has his 3 credit scores, and then they used the mid score of 640. And then Mary only has 2 scores, so they used the lower score of 630. Now, John's credit report shows there are 3 or more trade lines, therefore his credit score is valid. So again, he's going through streamlined processing. Now, Mary's score is under 640. There is only one trade line that has only been open for 6 months and an unpaid collection account in the amount of $500 reflected on her credit report. Now, they asked Mary for alternative credit references, but she does not have anything in her name. Mary indicates that the collection account happened because she moved from the area and did not pay the outstanding utility bill. There is not enough evidence that Mary has the ability and willingness to repay the loan. Now, there is an indicator of unacceptable credit reflected on her credit report, and she has not provided evidence that it was beyond her control or attempted to resolve the delinquency. In this example, John has an acceptable credit history, but Mary does not. So the application will be denied due to lack of acceptable credit because both applicants do not meet the credit requirements. Now, this is important right here because if you have a spouse, a significant other, or whoever it is that you're trying to, purchase a home with, that's why it's always important for you to know this person's credit score, their credit history, right? Know information about their credit, because you do not want to go into a situation like this blind and you've done all the work and you have all your ducks in a row, but whoever else you're going into this application or process with, they do not. So this would not be the time to be surprised by the results, if you've done your due diligence prior to. And that goes to like if you're going in the process with a family member, sister, brother, mom, dad, or whoever, right? So it's always good to do your due diligence. Now, in example B, Ben, we have Ben and Jerry. Okay, so Ben has one score of 580. Now, his report indicates no adverse credit, but he has just one open and active trade line. All the other accounts reflected on his credit report are old and inactive accounts. Now, alternative credit was requested to supplement the report, and I'll go over alternative credit later. A landlord reference and a 12-month history of his monthly power bill was obtained. The payment history for alternative credit that was obtained reflect that he made his payments as agreed. Based on the combination of traditional and non-traditional sources, it is determined that Ben has acceptable credit. So now, mind you, Ben's credit score is a 580. Okay, that's pretty low. But as you can see, after they reviewed everything they need to review, he was able to provide a 12-month history of his monthly power bill, paid all his bills on time. He was good to go. And then we have Jerry, who has 3 scores and no significant delinquencies. And as we can see, they went with Jerry's middle score of 740. So she qualifies for streamlined processing. So she does not need to pay off the collection accounts, as those are factored into the score that is deemed acceptable by the agency. Now, it doesn't precisely say here that, they're both eligible, and so they'll be able to move forward in the process. But as we can see, in this situation, wasn't a perfect situation here, but they both were able to qualify. So just wanted to go over the ability and willingness to pay and some of the things that USDA looks into, and knowing that you don't have to have a perfect credit history or perfect score, but if you can show that ability and willingness, then you'll put yourself in a good position. Now, it says little or no credit history. Okay, the lack of credit history on the credit report may be mitigated if the applicant can document a willingness to pay their recurring debts through other acceptable means, such as third-party verifications or canceled checks. So due to impartiality issues, third-party verifications from relatives of household members are not permissible. So this is another situation that will provide some information on, like I mentioned before, alternative sources. We'll go over preferred sources and then the alternative. So preferred sources would be rental, housing, your utilities if it's not included in your rent, telephone, cable, internet, insurance payments, payroll deductions to pay for your insurance premiums are not considered alternative credit. And then we have alternative sources, payments to child care providers, provided the provider is an established child care business, school tuition, payments to local retail stores, like if you have a credit card with Burlington, Old Navy, storage unit companies, monthly subscriptions, your Hulu, Netflix, Xbox, that counts, payment arrangements for the uninsured portion of any medical bills. Now, if you have a savings account, a savings account reflecting regular deposits resulting in a balance equal to 3 months of your proposed mortgage payments and similar credit sources. Okay, so child support paid is not an acceptable source. All right, so just some things to keep in mind. We're looking at those alternative sources. Now, payments on any installment account on a per account basis where the amount of the delinquency exceeded one installment for more than 30 days within the last 12 months. So we do know that most companies will report a late payment after 30 days. Some may report sooner than that, and then every 30 days thereafter that you continue to be late, they will continue to report to the credit bureaus. Now, of course, with installment loans, those are personal loans, auto loans, mortgage, student loans. Those are all installment accounts. Okay. Now, payment, that's your credit cards and like personal and business lines of credit. Now, this is what stumped me back in 2020. I thought I was ready to purchase my home. I obtained an application around September or October of 2020. Now, I had 2 late payments in October and December of 2019. So it had not been quite 12 months yet. So I actually was not ready to move forward in the process at that time. Now, a foreclosure that has been completed within the last 36 months. Any outstanding IRS tax lien or any other outstanding tax liens with no satisfactory arrangement for payment. Okay. Now, if you have 2 or more rent or mortgage payments paid 30 or more days late within the last 2 years, if the applicant has experienced no other credit problems in the past 2 years, only 1 year of rent history will be evaluated. This requirement may be waived if the program loan will reduce shelter costs significantly and contribute to the improved repayment ability. So this is something else I will touch on because I think that this will be great for you to understand what those specific situations are. So, exceptions to the credit standards. Rural development may consider exceptions to the credit standards in the following situations: reduced shelter cost, temporary situation, benefit to the government. Okay, so we'll go over all 3. Now, making the loan will significantly reduce the applicant's shelter costs. So, for example, the applicant's credit history indicates that for the last 3 months, they have had payments 30 days late. Now, they explained that their rent went up to $1,000 a month 4 months ago, which was a $200 a month increase from what they had been paying. They have been struggling to pay all their payments on time since the rent increase. However, prior to the rent increase, their credit report indicates that all payments were made on time. Now, the loan amount requested will result in a payment of $750 a month, which reduces their shelter costs and would likely result in their ability to make the mortgage payment as well as other obligations. So as we can see, this person was able to prove that, hey, before this situation, I made all of my payments on time, and then my rent goes up, and then I'm having a hard time, paying my $1,000 a month rent. So then that caused me to be late. And of course, if they were to get the loan with the USDA and they're looking at about $750 a month for mortgage, that will reduce their costs, right? Going from paying $1,000 in rent to $750 in mortgage. I mean, who wouldn't want that? So now the next situation is the circumstances were temporary and beyond the applicant's control. So now what this means is that the applicant may have adverse credit, but it is due to a reason beyond their control, such as unexpected loss of job, delay in benefits, inability to work due to injury, increased expenses due to illness, okay? And the issue is temporary in nature. So as an example, the credit report shows excellent payments until 18 months ago. Then there is a 6-month period which reflects late payments, but since then, all payments were paid on time. The applicant indicates that she was hit by a car 18 months ago, was unable to work for the first 2 weeks, then was on a part-time basis for 3 months. She did not have any sick leave and did not qualify for other benefits and was unable to pay her bills on time. However, once she was on a full-time schedule, she made arrangements with the creditors and was able to bring her accounts current and has since paid her bills on time. So in this example, it's evident that the reason for the delinquency was beyond her control and she's corrected the issue as soon as possible. Now, the last situation here, this is a rare situation, but I'll still touch on it. This is benefits to the government. So in this case, the applicant may be delinquent on a federal debt, and by making the loan, the housing expenses will be reduced, allowing the applicant to take actions on that debt, which will benefit the government. So again, while this is an exception which can be considered, be aware that this requires review and approval by the agency's admin, and it is rare. Okay. But as we can see here in these scenarios, USDA will work with you, right? So if you properly explain your situation, your credit history of your credit report can it coincides with your story and what you're saying, then they can definitely make exceptions, but obviously this will be on a case-by-case basis. But I'll also just touch base here quickly on significant delinquency and how they handle those situations. So it states, do not consider the significant delinquency as an automatic disqualifier. It simply means the applicant does not qualify for streamlined review. So do investigate and document. So they will ask, why did it happen? What was done to correct it? What does your credit reflect now? So the agency may be able to make an exception if, in fact, the adverse credit was due to extenuating circumstances beyond your control and it was temporary in nature. Okay, so really important. Now, the next bullet here says any outstanding collection accounts with a record of irregular payments with no satisfactory arrangements for repayment, or collection accounts that were paid in full within the last 6 months, unless the applicant had been making regular payments previously. So this was another one that stumped me as well, because when I obtained the application in September, or October of 2020, I had just paid off a collection account maybe about 2 or 3 months prior to that. So obviously that was within that 6 months, and I had not been making any regular payments prior to then. I just knew I had a debt and I paid it in full. So that was another reason for me to have to wait, until that next year to apply. Now, we have non-agency debts written off within the last 36 months, unless the debt was paid in full at least 12 months ago. We have agency debts that were debt settled within the past 36 months or are being considered for debt settlement. Now, non-agency debts are provided by private lenders. Agency debts are backed by the government. Don't have a lot of information about that. This is one of those things that if it applies, if it doesn't, then hey, you just keep moving. Delinquency on a federal debt. Okay. Now, a court created or court affirmed obligation or judgment caused by non-payment that is currently outstanding or has been outstanding within the past 12 months. So that could disqualify you. Except, a bankruptcy in which your debts were discharged more than 36 months prior to the date of application, or where an applicant successfully completed a bankruptcy debt restructuring plan and has demonstrated a willingness to meet obligations when due for the 12 months prior to the date of application, or a judgment satisfied more than 12 months before the date of application. Okay, so as we can see, there's definitely, these indicators of unacceptable credit, but this is not a, all-inclusive, or to say that, you would definitely disqualify yourself if, you fell in line with one of these. Most important thing that you will want to do is make sure that, you obtain that application, contact USDA if you have any questions, be upfront, let them know what your situation is, and to, see if you should go ahead and move forward and apply, depending on, which one of these you fall under. But, definitely, being upfront with your situation, asking questions, and getting guidance from USDA on how you should, handle your situation moving forward. So if you enjoyed this video, make sure that you like, comment, share, subscribe, and hit the notification bell to make sure you don't miss any future videos. So to homeownership in 2024. Peace.